Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne with David Ingles.
Good morning. Let's get to your top stories today. Stocks across the region slipping after or amid these fresh concerns over the Fed's independence. President Trump denies he is planning to fire Jay Powell, even though he hasn't completely ruled it out.
Meanwhile, Trump says the U.S. is closing in on trade deals with India and the EU as allies like Canada and Japan struggle to hammer out deals of their own ahead of August 1st.
And Couche-Tard trades barbs with Seven & i after ditching its $46 billion takeover bid. Reversals, I guess in some ways, is a big theme of the day when you look at the top stories, whether that's Trump and Powell and the pulling back, not fully on some of the earlier reports that Powell is about to go. That's reversal number one. Reversal number two is really on Couche-Tard and really what that means for Seven & i, and of course a reversal then of what's been, almost a year of negotiations. All that being said, we're flat across equity markets. We're going into the thick of earnings season, of course. The dollar is catching somewhat of a bid this morning following, of course, that drop that we had overnight. And certainly the steepening of the curve was one of the other themes that emerged last night. And at 112, that's within 1 basis point of the a 3-year high as far as the 2s and 30s are concerned. Right, the rest of the region looking like this. You have the Nikkei, you have the Kospi Index coming up on your screens within Japan. Of course, we'll unpack the Seven & i story in a moment. The other big one, which we've yet to touch on, but I would imagine will be key, following Nvidia, following ASML, will be earnings coming out of TSMC. In fact, at these levels, we should be extremely close, if not already, my producer's about to check this for me, at a record high on TSMC. More on that in a moment. Overnight, of course, the big move overnight, you had BYD, you had Baidu, of course, with, I think it was Barclays, or Jefferies rather, that came out and slashing the price target here for the ADRs in Baidu. A reversal of the AI trade. Kingsoft Cloud is one to watch when we go into the open today. And of course, BYD State Council meeting. We'll unpack this further for you later on. Promising to address, and let's see if they're able to make sort of progress on this, some of the irrational competition that we're seeing in the NEV space. BYD was down 1% overnight. Futures are doing this, and within the equity markets, obviously things like AI, things like EVs, we talked about that as well. Dollar China, and of course in the commodity space, Dalian iron ore, as you can see here, at about a 5-month high. We'll track that very closely going into Yvonne, the open today.
Yeah, I just did a check on my terminal.
Yeah?
You're right. We're very close.
Boom, there.
Flirting with those record highs that was set back in January for TSMC. So certainly one to watch throughout today. I'm going to have a preview from Bell coming out from there as well. Let's get to our top story. President Trump has denied that he is planning to fire Fed Chair Jay Powell after raising the idea in a closed-door meeting with congressional Republicans that leaked to the media.
He's a terrible Fed chair. I was surprised he was appointed. I was surprised, frankly, that Biden put him in and extended him, but they did. So, no, we're not planning on doing anything. We're very concerned.
It's the right of the elected president to appoint the next successor and go through Congress. And I think in that dialogue around that, there'll be a lot of dialogue about, okay, how do you set interest rates? What do you think about interest rates? Because the Fed is an independent agency. I think no matter who gets in, they're going to look at it and have to look at the facts and make a decision. Because if you drop rates too far, inflation may kick up, and then you're going to have to raise them back quickly.
Right, we touched on this earlier on. The 2s and 30s curve right now, as you can see, of course, a slightly more dovish Fed, if in the event that is, of course, the case. And, of course, on the longer end, maybe premium being built in the 30-year yield. Comments coming through out of Anna Huang, out of Bloomberg Economics here. We think Trump is testing the markets to see whether he can fire Powell, and just to complete that, maybe that idea, whether he can fire Powell without causing disruptions or massive disruptions in the markets.
It seems like, given the fact that the reaction was pretty muted after what we heard from that White House official, what does that mean? Does it embolden Trump to continue on this sort of campaign? It's not just him talking about it now. You do have more people in his circle.
All the president's men.
It almost seems coordinating this sort of effort. what to do with next. Let's bring in our news desk editor, Jill Desus, who's been tracking this whole Trump and Powell saga. How seriously should we be looking at this right now?
I mean, look, Yvonne, I think that, what our chief economist is talking about, what you guys are talking about here, this idea that this could potentially be a trial balloon, I think that's very probable. I mean, may not be very far off the mark. When you look at what he ultimately said, even in this, sort of open briefing with the press here, I mean, I'm not sure how much of a denial it is when Trump then later said, and I quote, "I don't rule out anything, but I think it's highly unlikely unless he has to leave for fraud." That seems to be kind of in line with what we've been hearing from some Republicans recently, which is that if there's a precedent for firing Powell, or if there's some kind of a thing that you would fire Powell for, they seem to be zeroing in on some renovations being done to the Federal Reserve headquarters, accusing them of being too lavish. Powell has denied this. He says he's actually invited an open inquiry there, but it does, I think, sort of raise that specter that clearly Powell continuing to be the Fed chair is something that has vexed Trump for months and months and months, if not years. I mean, he's raised the specter of, not just the idea of firing Powell, but that, Powell should leave multiple times. We've heard him express his dissatisfaction with him before. We know that Trump likely has a whole host of potential candidates to come and replace him. One name that continues to come up is Kevin Hassett. He's the head of the National Economic Council, somebody that has tracked, I think, more in line with Trump as being a critic of the Fed not working fast enough to cut rates. But again, I mean, the big question here is that it's really only, 9-10 months until Trump has the option to ultimately install, a new Fed chair, nominate a new Fed chair again. So I think the fact that you're getting all of this now, I mean, the possibility that Trump could be looking to remove Powell in some way, even if it's just less than a year out from when he would ultimately have a chance to put a new Fed chair in, just shows how much this really truly bothers Donald Trump. And again, I think, Yvonne, to your point about that fairly muted market reaction, yeah, I mean, if you just don't really have that much volatility. I mean, we saw, short-term yields fall a little bit, dollar fall a little bit, stocks fall a little bit, but there's no dramatic repricing in any way, right? So, I mean, maybe that does kind of enable him there. I think, it'll take some time to figure it out, but we'll see.
And we just showed the MOVE index, and yeah, I think on that note, to Jill's point, the bond market largely maybe doesn't care about this. Asking about tariffs too, there's also the latest lines there on 10 to 15% on about 150 countries. What do we know about that?
Yeah, David, I think that, it kind of speaks to what we've seen really over the past several weeks in terms of how Trump is thinking about tariffs globally. I mean, I know that we've had this conversation on this program before, but the idea that maybe Trump is looking at something of a little bit of a higher baseline level for global tariffs. This was kind of the intimation when we saw, some of the lines out of Indonesia yesterday, him setting this, 19% after, some lower negotiations. Vietnam, I think, around 20%. That was kind of indicating that maybe Trump is thinking that there's like a higher global baseline, higher than maybe the 10% that investors, markets were really thinking just a few months ago. If it is 10 to 15%, I think that still kind of falls somewhere in the neighborhood of, the way that we're kind of facing this new reality if there's going to be that base level of global tariffs. But I think we do have to see, I think one thing that has, been clear throughout the entirety of, not just Trump's second term in office so far, but also his first term in office is that, he does kind of, change his opinions a bit, but yeah, we'll see. There's an August 1st deadline ahead of us on tariffs. See what Trump wants to decide. Okay.
Yeah. Well, let's talk tomorrow then and see how things have changed. Jill Desus there. Thank you so much. Our news desk editor. Right. Just an update here. 7 and I will be resuming trade in about just about 8 minutes from now over in Tokyo. So we'll see, of course, after now we understand from both sides that it's now, well, severed in you is the opposite, of course, of that. Okay, let's bring it back to the top stories. Market strategy. Do we remain fully invested? Do we wait for more clarity on many of the uncertainties out there? Felix Brill is with us here, Group CIO of VP Bank, joining us here, of course, on sets, AUM of more than $60 billion. Nice to see you, sir.
Good. Happy to be here. Thank you.
So, do I lose sleep? Should I lose sleep over this whole Powell being fired? He might be gone anyway in 9 months' time. Yeah, it's a bit a strange idea, put it neutrally. It's a bit of a drama, I would say, isn't it? But at the same time, it's a very serious issue, isn't it? Because it's about the independence of the Fed. So
let's take the market reaction as, well, no one really believes he's going to go through with it. But if he goes through with it, that might not be as a good scenario, I would say.
How do you think that's being expressed? Seems like the dollar continues to be sort of the victim.
Yeah.
In a lot of the headlines that we get,
Yeah.
whether it's tariffs, whether
Not
it's
just
about
that.
Fed independence.
Yeah, the dollar is under pressure, has been for many months now. And many of the factors putting the dollar under pressure are still in place and might be even getting bigger. Foremost, inflation dynamics. It's not good for the dollar. Fiscal situation is not good. And if you risk the independence of the Fed, it's also not good news for the dollar. So mid to long term, the dollar faces a lot of headwinds. But at the same time, we see right now a lot of negative sentiment on the dollar. And whenever that is the case, like a small rebound is possible for whatever reason, because the sentiment is just too negative in the short term. And we advise our clients then take that opportunity if there's a rebound, maybe then to think about getting a bit less dollar exposure in your portfolio.
You guys are overweight EM bonds, and I wonder what the thesis is. Are they still the same classic reasons? And do you see any catalyst then for a reversal in, to your point, in the U.S. dollar then that might be a risk to that trade?
Actually, the weakening of the dollar is a supporting factor quite a bit because we know that the weaker dollar usually goes along with good performance in emerging markets, both on the equity side and on the bond side. But if you look at the bond side, we see that structurally the things have really improved over the years. Look at current account balances, fiscal situation, inflation, central bank policy. We have much improvement from a risk point of view. And so we think, and you get at the moment a nice yield pickup. So we think it's worthwhile to take a bit of a risk in order to get that yield pickup because it's treasuries, they don't they also face risks. So we think that it's a nice add-on to the portfolio.
Yeah, I had a guest talk about this. She called it the EMification of DM. Is real, where you're no longer seeing these developed market bonds as a safety haven anymore. No. But EM is becoming much more of a resilient asset class overall. Do you subscribe to that sort of view?
Yeah, definitely. So that overweight we just implemented comes on top of a strategic positioning in emerging markets because we think in the long term, of course, a lot of growth is happening in emerging markets. You have to be exposed in a global portfolio to emerging markets, that's for sure from a strategic point of view. But on top of it, also in the short term, if you look, as you mentioned, U.S. treasuries, also some European bonds, they are not risk-free. Right?
What about in equity markets?
Yeah.
Equity markets, well, honestly, we do not really know what's going to happen with the tariffs, what the final settlement will be, the regime, right? So on a daily basis, we get a lot of news. Maybe this market is now in focus, tomorrow the next market.
Does it matter longer term?
In the longer, if we get, high tariffs permanently, that will matter because that puts companies under pressure. In the end, there's no free lunch. Someone has to pay the bill. Will be U.S. consumers. And if, not only U.S. consumers, if there's a escalation, everyone has to pay a bill for it. And that is difficult for the economic environment, especially the transition towards that regime. But in the short term, markets seem to be still kind of a bit relaxed, maybe complacent. Maybe it's fatigue, I don't know. But in this environment, we say, well, fully invested, yes. You can't just, go away completely from markets. You should be invested. You see also positive news, right? And underlying the economy is doing well, but we don't pick and choose a single market right now. So we diversify across equity markets, fully invested, but don't pick and choose a single market.
How should I be looking at China in particular, right? It seems like the data for now is holding up, but everyone's talking about maybe there is going to be some payback once these tariffs, if in fact they do kick in, and the front loading sort of fades overall. But this equity market has been doing, relatively speaking, pretty well.
Yeah, definitely. And also now GDP data for the second quarter beat market expectations, which was a good sign, right? And we see so far China is managing quite well to go through that wall of worries, the uncertainty and the tariff situation, looking for alternatives. That takes time, but you have to buy that time. And so far it seems to work. But at the same time, we know there are headwinds. Private consumption is soft. So that is a risk. The housing market is still rather soft, not really recovering yet. So that is a challenge. But at the same time, we know the government has tools to support growth if necessary. So that is something to look forward. So therefore, we're actually quite positive on China for the time being.
I guess just a final note on just broadly tariffs and inflation. And we've yet to see whether or not it's showing up in a large way in inflation numbers, and of course the corporate earnings yet to be seen.
Yeah.
But should we assume that tariffs will start to show up in its various forms, and whether that's economic data or earnings coming through in the next few weeks?
Yeah, I would be surprised if it doesn't show up. And actually, we see early signs of pass-through. It's not strong signs yet, but if you look at the June data, if you look at appliances, furniture, toys, apparel, you see early signs for that. And it's still early days because I think there's still a lot of uncertainty on the final tariff regime, companies are probably reluctant to testing their pricing power, right? So they hold on as long as possible to pass through because they might still have inventories and so on and so forth.
Right.
But that becomes more and more difficult over time. And if more tariffs kick in, let's say on August 1st, we will definitely see a path through. There is no free lunch.
All right, Felix, thank you. Felix Brill there, Group CIO of VP Bank, joining us here right now. And we are just maybe about a few seconds away from what we're hearing from the Tokyo Stock Exchange of 7 & I shares.
Yeah, I'm checking my screen.
Are going to be resuming trade here. This is, of course, on the back of Couche-Tard really abandoning that $46 billion bid to acquire the company. You know, there's a lot of questions of what comes next, right? The fact that, you know, from Couche-Tard's side, it seems like they said they didn't feel like, 7 & I was very sincere in these negotiations or willing to come to the table in terms of some sort of takeover. And so, they have to prove themselves. They need to deliver now, according to Bloomberg Intelligence, on whether, is there really going to be, a case to be made to stand by itself or actually be taken over by someone else. So I think there's still a lot of questions on what this means for 7 & I moving forward.
Yeah, because there was an overlap between, there was a decent business case to be made, and I think the sticking point largely was the price at which they would sort of consummate that deal. But it does seem right now, based on what both sides are saying, at least 7 & I saying that Couche-Tard has one-sidedly terminated talks. It does seem, of course, that was a unilateral decision on one end. Now, I'm just looking at pricing. So we haven't yet actually, just to be clear, gotten a match on trading, but it does seem we are set for a decline here, and unsurprisingly, that's going to be the case, given, of course, that this is now no longer on the table, and suffice to say, at least for now.
All right, we'll let you know how things go once they do, if we see any movement on the stock. We're counting down the opens of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
Right, welcome back. You're watching The China Show. The fixing of the day now, the adjustment coming out of the central bank is, well, quite material in the sense that the actual level of the midpoint is, strengthening the fixing by the most since May. Now, that should not come as a big surprise given the weakness in the dollar overnight. And you know what? Blame the uncertainty around Fed and Powell and his job security there. But again, suffice to say, there's also the trade negotiations taking place. With Donald Trump, I think, saying it's 10 to 15% for about 150 countries. That's coming soon.
Yep, and so we're still waiting to see which ones those are. But certainly in the meantime, the dollar still seems to be a little bit on the back foot here after what we saw with this whole saga with Jay Powell and Trump, which President, did deny, but not fully.
Not completely.
But it was about an hour of certainly a little bit of distress in the markets, but it was quite muted.
I mean, if there's nothing to talk about, then let's not talk about it, right? But anyway, okay.
Anyways, let's get to something else that we need to talk about. White House sources are saying that President Trump has softened his tone with China, trying to secure a summit with Xi Jinping and a trade deal with Beijing. Let's bring in our chief North Asia correspondent, Stephen Ingles, on what we know so far.
Well, we know that he has allowed that H20 chip from Nvidia to go into China. That could potentially be perceived as a softening of the tone. We can talk about that in a little bit. We also know that essentially they came to another truce in London. That could be considered to be a softening of the tone. We do know that he wants a summit with Xi Jinping. China's not giving an inch right now as far as saying that is something that is imminent. So again, it looks like from sources, they're telling us that in meetings within his inner circle, oftentimes Trump is the least hawkish of the bunch towards China. He wants a trade deal and he wants a summit. And guess what happens in 2 weeks from tomorrow? That's that deadline of August 1st, right? August 12th is the deadline for China. So the clock is ticking really quickly. And yes, the indications are that they're working at a possible extension of that truce for another 90 days. But again, I think what's happening with Donald Trump right now, he wants some quick wins. He wants to cut some purchase deals like he did in his first term when he had that trade deal that obviously unwound because of the spy balloon and because of COVID and other issues. But again, he wants to get back on that track, do a trade deal, get some purchase deals, get China to commit to buying X number of soybeans or whatever. I'm, just extrapolating here. But again, he has taken a softer tone. Whether that's deliberate or not, we don't know. But the sources are saying the ultimate aim is to get that summit.
The reversal on the Nvidia chip story, how does that inform us of how soft Donald Trump has become on China? Or is that simply because China was asking for that, and in order to get that summit, they needed to give that up?
Well, I think it is part of the negotiations. What I find the most interesting, it wasn't the White House that announced it, because it would not necessarily be perceived as a win against China, right? So if you have the hawks who are saying be tougher on China, and you've had Scott Bessent, you've had Howard Lutnick, you've had these people use the H20 chip as an example of how the White House is being tough on China on those export controls. And in the past, these various individuals in the administration have indicated that there's no relenting on that. There's no negotiation on the high-end chips, even though, yes, the H20 was specifically designed for China as a watered-down AI accelerator, but still, it was added in April to the export control list, to the point where Nvidia was building another chip for China that was likely to roll out in September based on the Blackwell architecture, also watered down. But again, the fact that the White House didn't announce this because there would have been potential blowback, and it would have contrasted with the rhetoric that he had on the campaign trail and how others in his administration so far in the first 6 months of his term have been tough on China.
Steve, thank you. Our chief North Asia correspondent, Stephen Ingles, there. And really coming up, we have a great guest to talk about this, too.
Yeah, Eurasia Group unpacks that story for us, but the implications are broader implications, of course, beyond the headlines. Xiaomeng Lu joins us in a couple of minutes. Going into the open today, stand by for that, and looking at a touch of weakness coming through in the equity markets pricing. 5 minutes away the opening bell. This is the China Show. Right, welcome back. Before we take a look at and go into, in proper form, the open in Greater China today, an update on 7 & I. It just resumed trading a few minutes back, and we have been flirting in and around the 2,000 yen level. At one point, we were below it. Let's call it a 9% drop after, of course, this deal, or this potential deal, falls through with Couche-Tard. One-sided decision, according to 7 & I, to pull away.
And what does this mean, right? Can they do this alone and still unlock shareholder value? They've done plenty of things in the midst of all this as well, getting a new CEO and the like. And so certainly what's next for the company is a big thing. But the stock, as we've been talking about, right, rallied some 25% about 11 months ago when we first started hearing news of this. So potentially we could still see a bit of fallout here today. Here's your open in China and Greater China looking like this today. Onshore, it's pretty quiet overall. There's not a whole lot to tell you about. But we're focusing, of course, maybe there's a little bit more warmer sort of vibes going on in this U.S.-China relationship, as we just talked to you about as well. That fix was also quite telling from the PBOC, the strongest fix we've seen since May, just really reflecting that dollar weakness there. But that's really more about a Powell and Trump sort of drama that's unfolding that we saw overnight there. That seems to be stabilized a bit here, but still a lot of lingering questions on what these dollar sort of doldrums mean for this part of the world. We're flat when it comes to stocks onshore. We're watching very closely the tech space, though. Can we flip the boards and see how Hong Kong is doing so far? Hang Seng is flat, but we are seeing HS Tech on offer here today. Baidu seems to be one of the big culprits here. You know, we saw 2 solid sessions, of course. The tech shares have been doing quite well in the face of this whole Nvidia story, Jen-Hsun Huang in China, and really that whole H20 chips resuming in the mainland. But, you know, Morgan Stanley coming out with a pretty interesting note on Baidu, talking about the second quarter core ads, very likely to see downside surprise as well. But still, they are raising that target to the price to $100 from $95 for Baidu. We're watching some of the EV sector here today. There's a whole kind of talk about this whole irrational competition in the EV sector as well. So maybe more in terms of the regulatory side of things. We'll be focusing that with Min just a bit here. But yeah, most of these EV stocks are actually higher this morning. When it comes to New World, that was the latest there when it comes to what they might be doing. Our sources saying they might be looking into selling some of this 11 Skies Airport Mall, that as a way to maybe free up some liquidity there. Shimal Property also, there's some news on the restructuring side of things there as well that is going to be taking effect in just a few days, 4 days or so. So that's the latest there. Shimal Property is up about 2.5%.
Yeah, and we have a lot of guests coming through really to talk us through these big themes. Right? So HSBC joins us to talk about Chinese property. In a few minutes, we'll be talking with Xiaomeng of Eurasia in terms of the implications of the tech and geopolitics. Before we get to that, though, and certainly we'll talk about Jen-Hsun Huang in a moment. As Yvonne is pointing out, right, key levels to watch today, and we have been testing and we have faltered on the Hang Seng Tech Index at 5,500. HIBOR in about 2 hours from now has seen a mini uptrend of late, so we're trading at about highest since mid-May on HIBOR there, and of course as it pertains to tech, we talked about this already at the open. Iron ore separately is trading at about a 5-month high, and of course Jen-Hsun Huang is still in Beijing. In fact, speaking of the Nvidia chief there, he says that he hopes to get the first batch of renewed U.S. licenses soon to export H20 AI chips to China. Speaking in Beijing, he told us that his company, along with the supply chains, will adapt to any changes in the trading landscape. Have a look.
The world is reconfiguring itself, and we are a company, and we just have to adapt to whatever the world's trade and tax and tariff conditions are. There were trade, taxes, and tariffs before I came into Nvidia. There will be trade, tariffs, and taxes after I leave Nvidia. And so this is something we all have to adapt to.
For more, let's bring in Xiaomeng Liu, Director of Geotechnology at Eurasia Group. Xiaomeng, it's always great to have you on the program. I was going to get your take on this. I mean, overall, was it a surprise, you think, that Nvidia was able to get the green light and to resume the delivery of some of these chips to China? And overall, what do you think this means for their China business now?
I think this is an unexpected thaw of U.S.-China tech relationship. This is Jen-Hsun Huang's moment. What's more thrilling than running a $4 trillion company? Being a power broker between U.S. and China looks like he's doing it.
What does this then mean? Well, a couple of things, right? So I want to ask you what you think about what the implications are for the domestic chip makers in China, and whether or not we should view this as negative for that specific group, Xiaomeng.
Right. I think depends on where you sit in the Chinese supply chain. You'll feel differently about this news. It's very promising update for DeepSeek, because previously the Chinese model faced deployment challenges because Chinese cloud service providers ran out of H20, which DeepSeek heavily relies on to scale its operation. With much wider access to NVIDIA's AI chips, this pain will ease and adoption of DeepSeek will accelerate. But Huawei may not be as excited because they have been attempting to compete with NVIDIA, but struggle with a lag in manufacturing capacity as well as software ecosystem.
Xiaomeng, what does it tell you about the Trump administration's overall stance in export curbs now? I mean, before it was what, the small fence, high bar, or I forgot what it was called, but
small and high fence.
So yeah, how would you classify how they're dealing with this particular sector now? Because it seems like at first NVIDIA chips to China was almost like a red line. Yeah. That is being put to question now, and it seems like it's all transactional.
Yeah, there seems to be this change of mind of Trump administration, which is unprecedented, which is a major shift away from what Washington has been doing, an entrenched effort for the past 7, 8 years. All of a sudden, they decided that actually decoupling with China in certain part of the supply chain is a good thing, good for consumers, good for U.S. company, and it's good for the U.S. I think the previous guest on the show talked about what are the drivers of these changes, but it seems to be a very sudden shift in the temperature of U.S.-China conversation in Washington, D.C.
And just to follow up on Yvonne's question, the temptation is to then conclude that the U.S. has given up on trying to stunt or stop China's semiconductor progress. Do you think that's the right conclusion to make? And if not, in what other form do you think the tightening then shows up in the future, Xiaomeng?
I wouldn't go that far, as they are going to relax all the controls on U.S. AI chips exports to China. I think Lutnick was talking to reporters yesterday. He was saying that we are giving China only 4 generations behind us, and that will get them addicted to the system enough. They're going to heavily rely on us, and that's the thinking. I think this is just an initial thaw of the relationship. I think people like Jen-Hsun Huang will keep pushing this conversation and moving the needle as far as he can, but I think there's a good chance the China hawks in the U.S., the security-centric policy decision makers will push back on this industry win and try to reverse, at least notch back the recent change in Washington.
There's so much talk about China's self-sufficiency and whether they can continue on despite these trade tensions. I mean, when you look at overall the supply chain, are there parts where you still see challenges in China really advancing in its competition with the U.S.?
Definitely. I think lithography machine is a great example of that. I think it still takes them a long time to find an alternative to that. And even for Nvidia chips, maybe while they have some alternative that's advantageous in terms of computing power, but in terms of the software ecosystem, Nvidia built on called CUDA. I think that's still the easiest, most convenient way for small startups and application developers to plug into the system. I think that's a moat that make the Nvidia chips very, very valuable still.
Xiaomeng, final question for you, I guess, another follow-up there is, do you now think, I think the point on lithography, right, and we heard from ASML yesterday in their earnings, do you think then the Dutch and the Japanese might follow suit here because of this sort of slight opening that the White House has now created?
I think there got to be interest from countries like that, third country that hold crucial IP in the chip supply chain, trying to take this advantage and explore opportunity to advance their own course. I think that's definitely a direction they're going to pursue.
Xiaomeng Lu, thank you so much. Director there of Geotechnology at the Eurasia Group, on just important, really, context there on what this means, but to what extent it actually then means a loosening, and maybe just don't get too ahead of yourselves there. Right, the other big story we're tracking, shares of 7 & I have been up and running now for about, it's called 10 minutes or so here over in Tokyo. So we're down about 8-9%. We're trading at about the 2,000 yen level. Before this Couche-Tard offer came through, we were trading just below 1,800. So there is still a little bit of premium, but I guess you also have to sort of discount that the market itself has also gone up since that point in time. Now, the Canadian firm is accusing the Japanese firm of a deliberate delay during the almost year-long pursuit, a claim that then the Japanese firm then says it disagrees with. Let's bring in our Montreal Bureau Chief, Matthew Dion, who joins us right now to talk us through this. And who's at fault here? They're both pointing fingers at each other, Matthew.
Yeah, I mean, it's really a bill or letter that Couche-Tard sent to the board, to 7 & I's board today. So, I mean, since the beginning, since this story got leaked in August, so let's go back almost a year ago, you always felt that Seven and I didn't want to engage with Couche-Tard. So Couche-Tard came in with a first bid at $38 billion, and then a second one nearing $50 billion if you take the conversion back then. And there was another one afterwards where they just tricked it with currency, and then that was nearing $50 billion. But so that represented a almost 50% premium on the undisturbed stock price back then. And despite that, you could always feel that Seven & I refused to engage. But Couche-Tard was being polite all along. At one point, they were just saying in Tokyo during a press conference that it was hard to engage with Seven & I. But today, in that letter, we really see the frustration they had all along about the lack of engagement from Seven & I, because this company just didn't want to sell, and we could feel it from the beginning, and now we're seeing it today, despite the non-disclosure agreement they had signed in May. I mean, it just didn't happen. They were not sharing information, and that is what Couche-Tard is complaining about in this letter.
Matthew, is it done then for Couche-Tard? I mean, you know, Seven & I had said it was they had one-sidedly terminated these talks. That, you know, maybe is there still room for negotiation moving forward?
Okay, so let's go back 20 years ago. Couche-Tard came in, approached Seven & I to buy the company. They've done that several times. They made something very special last summer with a letter and an offer price. It's a company known to be patient. I mean, for the founder, Alain Bouchard, who started with one convenience store in Quebec, Montreal, he's always thought of being the largest convenience store in the world, so it will always be a goal. But I talked to a person familiar with the matter tonight, because we are tonight here in Canada, and he said, this is done for now. This is really done for now. It's not a tactic. It's done. Maybe they could come back in a couple of years. Maybe that's always a possibility. But as long as Seven & I doesn't want to engage, as long as shareholders of Seven & I don't come out to pressure Seven & I to sell the company, I mean, Couche-Tard is stuck and cannot move forward.
Matthew, it's great to have you. Thank you for staying up late for us. Matthew Dion there, our Montreal bureau chief with the latest there. We got to talk about these Aussie job numbers because they've always been quite volatile, and this is what we're hearing here today. Rising 2,000 jobs. So they added 2,000 jobs month on month.
Yeah.
The estimate was, get this, 20,000, Dave. Jobless rate was a little bit higher, though, 4.3% for June. The estimate was for 4.1%. Part-time employment, though, we did see that rise from 40,000 jobs. But yeah, that probably is right. We are seeing the Aussie dollar a little bit heavy here this morning.
Yeah, the full-time employment gauge was what really pulled this one down.
Yeah.
So negative 38,000 jobs, job destruction in June there for Australia. Right, plenty more ahead. This is Bloomberg. Welcome back. 60 minutes into the cash market session. EVs in focus, and we're looking mostly at gains. NIO, of course, to the downside. Big drop in NIO shares overnight in the U.S. This might be down to some strong language coming through here out of officials. They're now looking, or they've pledged to rein in what they now describe as irrational competition in the sector. He signed that they're perhaps getting more concerned about the price wars threatening economic growth. Min Lower China correspondent is here with us to talk us through where we heard it from, who said it, and in what context.
Yeah, so we got this from a CCTV news report, that's the State TV, and Premier Lee had chaired a State Council meeting, and this came from that meeting where the government is pledging to rein in this unhealthy competition by stepping up investigation and monitoring of prices. They're also asking these car makers to enhance their competitiveness by doing more product innovation, increasing the quality of their products rather than cutting prices. But of course, realistically, how is is this going to be implemented? Whether it's going to be penalties on certain companies that sell cars below cost or that makes very unreasonable price discounts, it's still not very clear how it's going to be enforced. We do know that last month the government had summoned the leaders of some of these car makers, asking them to conduct self-regulation on prices. So I guess if the self-regulation doesn't work, the government is going to step up intervention. And of course, it shows that the government is really serious about tackling this problem of deflationary prices at the factory gate, not just in the EV sector, but overall we've been seeing prices declining for over 30 months now, and that's a big drag on economic growth and also on corporate investments as well.
There's been some news on Tesla. In China, they're maybe possibly readying a new version.
Yes,
of the
they
Model
have
Y.
announced that it's going to be a new sort of six-seater SUV type of car. It's 15 centimeters longer than the Tesla Model Y. And this is something investors
15 centimeters longer.
Yes. Six-seater, so another row of
5.9
seats at the
inches,
back.
Dave. And only
Like,
6 seats.
how is that bigger? That's like my phone.
Slightly bigger.
Okay. Anyway, sorry.
Maybe the seats are narrower.
Yeah.
But yes, investors like it because you look at the share prices overnight and increase, right? We're also checking the Tesla supplier stock also increasing here in Asia as well. But you look at Tesla's overall lineup so far, it's been seen as quite stale if you compare it to some of its Chinese competitors. They've been coming up with new products, new models at a much faster pace with very advanced sort of features in their cars. And you look at Xiaomi, for example, it's taking on Tesla directly with very similar models, very similar price points, maybe just under the Tesla price point. Xiaomi already introduced its SUV model last month to very strong reception, 280 over 1,000 pre-orders in the first few months. So the real test is when Tesla launches this sometime in the autumn, what is the reception going to be like? Because they just managed to snap this 8-month decline in shipments out of the Shanghai factory. So in June, they saw a very modest increase, 0.8% higher. We might be seeing sort of the bottoming out of that trend. Maybe this new car can help them lift that sales a little bit more.
And why do a 6-seater? I'm sorry.
Yeah.
But 6-seater doesn't seem that appealing.
No, it brings to mind. This is a random thought, right? So when I order an Uber XL, and then a Tesla shows up, I'm somewhat disappointed because
Why?
I'm expecting a larger van to come up. I guess to the point you're making.
For you.
I need to stretch my legs. Right? You know.
Also, I have a family of 5 now, so I'm like, a 6-seater doesn't cut it for me. Even 7-seater doesn't cut it for me these days.
I just like the one where the car doors open sideways.
Like Dumbo's ears.
Yes.
Right, anyway.
All right, Milo, thank you. Our China correspondent with the latest on all things EVs. In other stories that we're tracking out of China today, the Financial Times says the U.S. communications regulator plans to ban Chinese technology in submarine cables connected to the U.S. The FCC chair, Brendan Carr, is quoted saying that if the rule is approved, Chinese firms won't be allowed to build, operate, or lease capacity on future cables. The rule would apply only to new license applications, not existing infrastructure. Chinese developer Shimao says it expects to complete the restructuring of $11.5 billion in offshore debt by next Monday. That adds to around $1.3 billion in yuan-denominated loans already extended in 2025. Shimao has said it's sold 8,300 homes so far this year, meeting its own target. And there's more on China's property problems in the next hour. We'll be speaking with HSBC to get their take on which their preferred stocks in the sector are as we head into the earnings season. Michelle Kwok joins us pretty soon. This is Bloomberg. All right, we are checking movers here this morning. Huawei suppliers in focus here after what we heard from some data that Huawei actually topping the smartphone market in China for the first time in years. So the suppliers are doing quite well here today. And we're watching very closely what this means, right? The whole Nvidia story, does it actually impact Huawei's in terms of AI chips or chips and the like there? That certainly is the bigger question that we're looking at here today. But the suppliers are doing well in the face of this highlight and milestone for the company. Tesla suppliers in focus, as we just talked about, this new plan of a Model Y L, 15 centimeters longer
than the other one.
Tesla suppliers. CATL is the one you have to watch, though. We'll check that one in just a little bit time. Macau casinos as well, right? So we knew this was going to happen, right? Second quarter of VIP gaming revenue actually rose to the highest since the fourth quarter of 2019. So certainly we are seeing quite robust numbers coming through in terms of gaming revenue. The VIP sector in particular seems to be the highlight here, but mixed picture across some of these Macau casino operators. Wynn Macau, for example, is doing one thing and up about 1% as well. We're watching the dashboard here. You know, it seems like it's a pretty decent day for equities here. Hang Seng is doing a little bit better, and so is MSCI China. We're up about half of 1%. Dave, anything you want to add?
I'm tracking, so it's largely quiet but decent, as you can see, everyone is pointing out in the equity market. The one thing that I would just single in on as it pertains to this visual on your screens is bottom right. Iron ore prices have silently creeped up to just under 800 renminbi there. And at that level, we're actually back to the highest level here since Feb. So that's just, I guess, just a note there. 10-year yield down to 166. We're looking at repo rates following the injection this week coming out of the PBOC. So repo rates have resumed their downtrends. And on the opposite of that, here in Hong Kong, maybe later on we'll get an update of this. HIBOR is actually on the way back up to about 2-month highs on that. Plenty more ahead. The second hour of the China show is just ahead.
Welcome back to the China Show. Here's a look at the HSI half hour into the session. And yeah, we're seeing decent gains here today. We're up about 0.4%. But yes, it is a bit of thin trading here. We also have had a pretty spectacular sort of run already, right? Yesterday, we did hit those the highest levels we've seen in about 3 years for the Hang Seng. So maybe we're trimming some of the gains at least here right now.
Yeah. And I mean, we are hitting, and I think we're going into earnings season, right? And I think some of the commentary that's come through has been largely market moving. So we've talked about Macau, of course, and the movers there. Baidu is another good example of that. That's coming up on your screens very shortly, with Morgan Stanley coming out with a note ahead of earnings coming through, I think in still a couple of weeks' time. I'm expecting some weakness to come through there. So Baidu was down overnight. Jefferies came out and slashed their price target for the ADR. And then Morgan Stanley came through earlier on with a warning on this specific stock here, down about 3%. Xiaomi is down about 1%, and nothing much else as far as the others are concerned. Although, of course, we have seen quite some gyrations in the share price of many of the big platform companies like Baba, on the way up and on the way back down this week. JD.com is part of that story. Meituan is actually, last I checked, one of the ones to the upside, but that could be changing as I speak. Right. Speaking of changing as we speak, is really the conversations around, is Jay Powell's job at risk? Is he going to serve out his term? Is Donald Trump pulling back, and to what extent he's pulling back? Some of the comments coming through there, but it doesn't seem like he's putting the story to bed completely here.
Not completely ruling it out, and still continue to attack Powell in some ways. But it was interesting, right? You talked about that mini reaction that we saw. Maybe it took about less than an hour once Trump clarified, but you did see that massive steepening of the curve. Dollar retreated, stocks retreated just a little bit, but overall it was a pretty muted sort of response as well. So, Anna Wong from Bloomberg Economics had a great take on this, and she says, look, is this just them leaking this information in a way to really test the markets to see what, traders are going to do in the event of a Powell firing? Who knows? Maybe. Certainly that's one question that we're going to be asking. But here, President Trump is denying that he's trying to fire Fed Chair Jay Powell after raising that idea in a closed-door meeting that did leak to media. Here's more from the president.
And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad. So we have a stupid person, frankly, at the Fed. I call him Too Late Powell because he's always too late. I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. I'd love him to resign if he wanted to. He's done a lousy job. Jerome Powell's been very bad for our country. We should have the lowest interest rate on earth, and we don't. He just refuses to do it, and yet he's spending $2.5 billion rebuilding the Fed. He's a terrible Fed chair. I was surprised he was appointed. We're not planning on doing anything. We're very concerned.
Mark Reinfield joins us from Singapore to help us distinguish, Mark, noise from signal here. Or is it all noise or all signal, Mark?
I think this is one of those situations where traders were really hoping they wouldn't have to face this situation where they need to price in the risk of a Fed chairman going ahead of his time. I think they would have liked to decide, is it just noise? And yet the number of times it's being talked about, the different ways in which the subject is being brought up, traders are beginning to say, okay, this is no longer a black swan event. It is something we need to give some credence to. So at the moment, if you look at the way the options market is pricing and the futures market, it's probably saying that traders are giving it about a 25% possibility that Jerome Powell doesn't see out his full term as Fed chairman. The more that it gets talked about, particularly by President Trump, the more traders will have to take it seriously, and you will probably see those odds start to increase. Now, it may well be that Bloomberg Economics are right, that Trump will be watching the market reaction. And if the market reaction is not too severe, then maybe that is the telling point that makes investors say, yes, this is a real possibility and it could happen sooner than later. So everybody is watching the movements in the markets, the pricing odds in the futures, and the betting markets as well. You put all those together and it's beginning to look like a case of no smoke without a bit of fire.
Either way, then, I look at it, right? If it happens, obviously there's a question of Fed independence. If it doesn't happen, either way, it seems like there is a repricing going on, that even if he leaves in May of 2026, they're going to appoint someone that is going to be dovish and more dovish than Powell. That's both still seem to suggest a weaker dollar moving forward, Mark.
Yes, I think this combined with other policies which the current White House is doing are detrimental to the US dollar. That you can see that's creeping in to the foreign exchange trading world, is that gradually confidence in the dollar is being eroded, not just because of the Federal Reserve, but because of their policies on tariffs and also on the big bill they recently passed, the tax and savings bill as well. That looks as though it will make the US deficit worse than it was already bad. It's going to make it even worse, which will again threaten the sovereign rating of the United States. So there's a number of things building which are all undermining the US dollar on a gradual basis. The Fed is just one of those many factors. The way the market is pricing at the moment, the assumption is that most of those rate cuts will come in 2026. What they're not aggressively pricing for is the risk that they're brought forward into 2025, and that's something the markets will have to watch. If that changes, again, that will weigh on the US dollar as well. If we think those rate cuts are going to come fast and furious, let's say from September, maybe even starting with a big one like a 50 basis points cut, that is not fully priced into the market, especially not into the value of the US dollar. So there's a lot of moving parts here, and it looks as though traders just won't be able to relax. There's no summer holiday for traders this year. They're going to need to stay on the alert all the time.
Mark, just to ask as well, because I can't seem to wrap my head completely around so something that I think about is, say, the Supreme Court, right? The U.S. Supreme Court, the U.S. president has control over who he nominates there. That's personality-based. It's based on how they've interpreted the law in recent, in recent examples. But the Fed, while the president does have a right to choose, of course, who the Fed chair is, the decisions of Fed officials are largely based on the economy. That's just a long way of trying to ask you, Mark, is there really a case to cut interest rates and bring them sooner if indeed we do get someone else heading the Fed tomorrow, for example?
They can always find some data to support their case. It depends how you slice and dice things, really. If they pick certain aspects of the inflation data, the Fed has a preferred gauge of the PCE, and if they change the moving averages, they can easily make the PCE look much tamer than it is, and they can justify a case for lower interest rates on that basis. The unemployment situation doesn't really seem to suggest that they need to cut interest rates yet, but that could change quickly. Already, just in the past few days, Donald Trump has been approved to allow more cutting of jobs in the U.S. State Department. So there's going to be more government job losses coming up. So that could deteriorate quite quickly. That would support rate cuts as well. Finding data to support interest rate cuts is not that difficult. And economists and Fed people probably can find a way around that. It's more a question of how it reads to investors globally. How does the loss of independence filter into markets in a way that undermines treasuries and the US dollar? So it's really more about the optics and the timing rather than whether you can always find a reason to cut interest rates, much easier than hiking rates.
Mark, thank you. Our MLS strategist, Mark Cranfield, there joining us out of Singapore. We're also tracking one big story here today, and that is the shares of Seven & i tumbling in Tokyo here this morning after Couche-Tard announced it's abandoning its $46 billion takeover bid. Now, the Canadian owner of Circle K stores says the Japanese firm refused to engage during the almost year-long pursuit and ran a campaign of deliberate delay. Seven & i, which runs the rival 7-Eleven chain, disputes that, insisting that it engaged in sincere talks and is disappointed by Couche-Tard's decision to walk away.
Now, for more on what this means for Seven & i, let's bring in our Asia consumer analyst out of Bloomberg Intelligence, Leah El-Hage in Singapore for us. Leah, this is it's a story that's, it's binary. It's an either or. So with what we know now, tell us about what you think the impact likely will be on Seven & i and its strategic direction to really bring value to its shareholders now.
Thank you, David. Yeah, so the Couche-Tard withdrawal actually removes key bid premium for the stock, which was around 19% yesterday. As of close yesterday, it probably dropped now to 12% after the share price drop. But that actually, the withdrawal could help the company strategically, as it will allow the management to actually pursue its transformation plan. And this includes a $2 trillion share buyback program, and which we think could lift return on equity by 2030. And they also plan on IPOing their North American operations. They're also working on revamping their operations in Japan as well as the US. But definitely the stakes are higher. So execution risk is in focus. And without the bid, Seven & i must prove it can actually extract more value on its own rather than through the sale.
Yeah, as your reaction piece said, it's time for them to really deliver. You mentioned about the IPO of its North American operations, Leah. How critical is that in unlocking value and supporting the company's growth ambitions?
So the IPO of the North American operations, or rather, if the company would consider floating part of the operations, it's aimed at funding the $2 trillion share buyback program, which I previously talked about. Also, the company has plans to expand to 100,000 stores by 2030, and they cannot do that only organically. So that will require some bolt-on and M&As and probably big-scale M&As, which the IPO, along with the sale of their superstore operations, would be able to fund those. And they would need to do that also without reaching their leverage targets. So beyond beyond M&A and buyback, also, as I've mentioned, the company is reinvesting in its operations. They're revamping their stores, especially in the U.S., which makes up 3/4 of the company's profit. But then again, also for the IPO, timing and execution will be key in terms of investor appetite, market conditions, and they all would need to be aligned for that to happen.
Leah, it was great to have you. Thanks so much for bringing your insights there. Leah El-Hage there, our Bloomberg Intelligence Asia consumer analyst, joining us from Singapore. Well, still ahead on the China show, troubled Hong Kong developer New World is looking to offload its signature 11 Skies airport mall in an effort to raise some money. We have details on our scoop coming up. All right, you take a look when it comes to what we're seeing in the property space. I mean, for the past 3 years or so, that gauge basically hasn't really done too much in terms of recovery, right? It really kind of coincides with what we've been seeing, the data this week as well with new home prices. Those declines seem to be getting more steeper than before. And there was a lot of anticipation that we were going to see something in this big meeting earlier this part of the week. That also disappointed in some ways as well. So, the issues that we've seen in the property sector have dragged on the economy and equity markets as well. And we talked about that whole meeting. It seems like maybe where people were anticipating too much, possibly. Let's get the take from HSBC now on the back of that. They think that, it's really about the quality of this urbanization now, this new model that they've been talking about that came out this week. Let's bring Michelle Kwok. She heads the Asia real estate research at HSBC. So, seems like the market got a bit ahead of themselves about what we could have seen with this meeting. What does it tell us about where policy support is going to come through?
I think the market is still building expectations that there will be another meaningful round of policy coming through. Whoever you speak to on the street, I think there's a very clear view that the government this time around is very much determined. I think what is really facilitating this view is also since April, we have seen a slowdown in sales momentum. So building up 6 months of very good sales, but since April, with the trade tension kicking in, sales has moderated along with the home price data, which has weakened.
What's caused that?
I think in part because we have had 6 months of very strong data.
Yeah.
The market felt that maybe a bulk of the pent-up demand has already been taken up by the market. And then, of course, we have trade tensions kicking in back in April. So I think it's a combination of factors, but more importantly, it's just about the market feeling quite unsettled that home price in some cities are still correcting.
What can we expect in terms of the next sort of dates? I mean, the Politburo meeting seems to be the next sort of pit stop, I guess. Do you think we're likely to hear anything then?
I'm never a subscriber of identifying dates because we have learned over the years that policies can really come anytime. But how the market is thinking about it is July could be a window, end of month, but the other window of opportunity is in November.
Okay.
Window for what? What's a realistic expectation to have?
Form, yeah.
I think that in HSBC's view, we really don't expect anything very meaningful. Anything that has been announced since 2024.
Right.
We have had rate cuts, we have had down payment cuts, the relaxation of home purchase relaxations, all of them is there. So I think at the moment what's very important is for the government to really execute. And I think the one key aspect is inventory acquisition. If the government can push through, accelerate, and maybe do it in a more aggressive manner, that can actually move the needle.
Okay.
What are you expecting out of this earnings season? We've already had some profit alerts from the likes of Huang and the like. How do you separate between who's going to do well and who's not?
We don't project interim earnings because it seems there's no way to do so, but I think what we can point to is the base effect. I think in first half 2024, we have had companies like CR Land, we have had companies like CND that had generally quite a low base. So what that means is that first half of this year should be quite favorable for them. On the contrary, Kohli had a high base, same period last year. So what that means is that the market generally would be more cautious in terms of thinking about what they can deliver during the period.
In terms of which city tiers are doing better than others, in other words, tier one over the rest, or is it what price points are doing well within, say, if it's tier one that's doing well, within that, what price points are doing well? What segments do you think stand out to you?
It's going to be a luxury. Luxury held up very well and actually surprised us through the down cycle.
Okay.
We have been in and out of China the last 2 months.
Okay.
We went to Beijing, Shanghai. What we actually learned is that if you're in the luxury market that caters to upgraded housing demand, you will sell through. And in some instances, you can actually raise prices as well.
Okay.
What are your, I guess, assumptions for housing demand moving forward? I think Goldman had a line just a few weeks ago that, they're going to stay around 75% of the peak.
Yeah.
How are we going to be looking at this sector here in maybe coming months or years' time? How do you compare that to 2017?
I'm actually quite constructive.
Okay.
I'm quite optimistic because I feel that the pain is already behind us. 2024 should be a floor. This year, we're projecting for volume to be flat to maybe down 5% or so. But of course, it really depends on the momentum the next couple of months and if there is going to be more meaningful policies coming through. What I think the market should really focus on at the moment is, of course, there's going to be a lot of pain. It's very convenient to still be quite negative on China property. But I think that what the market has not really focused on, and that's really going to make a difference, is the decoupling, what we've seen in the tier 1 cities, tier 2 cities. New home versus secondary home, but even within the top tier cities, there are properties that won't probably ever sell. There are properties that are still highly sought after and that actually has a positive pricing momentum.
Right. Yeah, because us in the media, we operate based on data that's given and released, and sometimes one of the most frequent data points that we get is the 70 cities, right? And I wonder how useful that is looking at this market wholesale when, to your point, you will miss the good story if you simply focused in on that. So what then do we pay attention to? Like, what do you pay attention to?
I look at this data. This data is important because I think the market look at this data very, very closely. So they would determine the market movement. But what I also pay attention to is increasingly top-down fundamentals. What are the big themes in the market? The big theme is we're in a lower for longer rate environment. But the bigger theme from a real estate perspective is we have a supply squeeze. Yeah. Why I say that is because when you look at 2 data points, new starts versus home sales. New starts down 70% from the peak. Home sales down, give or take, just around 50%. Yeah. So what that means is that in a market whereby no one is really buying a lot of land bank, you just really don't have a lot of quality new builds. But more importantly, I think going bottom up, deeper, that's very, very helpful for us in terms of formulating what we think would help the market navigate through a recovery, where we can actually think about which developers can capitalize on emerging opportunities.
Right. And just very quickly, are clients and investors receptive to that good news? Because largely, the China property story was negative wholesale to many people. And I wonder how receptive people are now to some of the bright spots there.
They're very receptive. Okay. They are just not positioned that way. They're verbally very, very positive. Yeah. But I think what happened the last couple of years still making them a little bit nervous. Yeah. There's still that bitter taste. But I think if we look at the performance of some of the key stocks that we like, for some of them, right, even though they don't really understand that story, they are just still going in just because they don't really want to miss the boat.
Yeah, okay. At least they've signed up for the gym. They just need to go now. Michelle, thank you so much. Michelle Kwok, their head of Asia Real Estate Research at HSBC. We'll be back in a couple of minutes.
The world is reconfiguring itself. And we are a company, and we have to adapt to whatever the world's trade and tax and tariff conditions are. There were trade, taxes, and tariffs before I came into Nvidia. There will be trade, tariffs, and taxes after I leave Nvidia. And so this is just this is something we all have to adapt to.
My script says that was Jen-Hsun Huang. I don't need to say that. I think everyone knows who he is. The latest they're coming through, of course, he's in Beijing currently. Let's bring in our tech correspondent, Annabelle Jewelers, in Taipei for us. Belle, it's certainly a win, business and PR for Nvidia, but we don't know yet how long that will actually last.
Yeah, and I think you also sort of got that context from Jen-Hsun Huang when he was speaking yesterday with reporters in Beijing. But really, it's trying to understand how much of that potentially lost revenue. So analysts have been thinking it could have been up to $15 billion in revenue for 2025. How much of that can now be recouped as a result of this prospect that they're going to be able to send H20 chips once again? So he was saying, again, they're still deciding that, reaching out, of course, to their customers or would-be customers to try and understand that demand potential. But we had a note actually out from JP Morgan just in the last few minutes saying that this is incrementally positive for some of the cloud operators in China as well. So again, just trying to understand the demand dynamics. I'm sure he's meeting with a lot of customers as well.
Yeah, certainly trade and tariff risk will be a focus when TSMC reports a little bit. Give us a preview real quick.
Yeah, so we've got the earnings coming up in a couple of hours' time from now. And as you said, that focus on anything they say around tariffs, trade is going to be really important. We do understand that Taiwan is thinking that a trade deal with the US is possible before August 1, but also trying to understand would they be looking to expedite any of their capex in the US given the incentives that are in place.
Belle, thank you so much. We got plenty more ahead. This is Bloomberg. .29 a.m. in Tokyo. Japanese markets are heading to that lunch break in just a moment, and you are seeing the Nikkei. They're slightly to the downside. There's not a whole lot going on in the equity space, except, really one company that really made it to big news here this morning, Seven & I, of course, with Couche-Tard abandoning that takeover bid. So a lot of questions of what's next for Seven & I. Can they actually do so alone and really unlock shareholder value? The stock is down. We're off some of the lows, but we're still seeing declines of about 7% in Tokyo this morning, Dave.
Yeah, the inconvenient truth. Let's have a look at the region here. You know what? I'm just going to make it short. There's really nothing happening. We're flat on the benchmark, and there's no volumes coming through right now. So let's talk politics. Why not? You have the Australian Prime Minister, Anthony Albanese, of course, is visiting Chengdu, last leg, of course, of his 6-day visit to mainland China. He was joined in Beijing and Shanghai by a delegation of business and academic leaders. Now, both countries say that they have agreed to boost exchanges and navigate their differences wisely. Joining us now is a member of the Australian delegation. Sharon Pickering is the Vice Chancellor and President at Monash University. Sharon, thank you for joining us. Just give us a sense of how was the trip? Tell us how things went.
Look, thanks so much for having me. The trip went incredibly well. There's a lot of developed mutual understanding. There's a lot of long-standing relationships. With the relationship being stabilised, it's great for all business, but it's particularly terrific for education institutions such as Monash and other universities that have got long-standing relationships, not only with China, but with nations right across our region and indeed around the world.
And can you tell us a bit more about what this means, from Chinese students coming to Australia, for example, to study? I mean, have you seen an uptick or more prospect of students from the mainland coming to Australia to study?
So what's really important to us is to understand international education in a multifaceted way. While Chinese students coming to Australia is an important part of this, Australian students going to China is equally important, because what education is all about is developing those people-to-people relationships, those networks, and importantly, that understanding that can form the glue between nations and across regions, and that remains stable. Despite what might happen between broader relationships or geopolitical shifts, the way that we develop that understanding together is important. And if that remains stable, then everyone can have confidence. Families in China wanting to send their students abroad to universities such as Monash can have really high confidence. Students travelling from Australia to China to develop understanding of our largest trading partner can occur. And of course, all of the relationships around some of the big challenges that we all face can occur. Issues around the energy transition, around the development of greater decarbonisation technologies, health innovation and so on, all of those things can occur if relations remain settled and stable.
Sharon, what does that pipeline then look like? The flow of students to mainland China from Australia, and what do you think, if it's still not clear at this point, what do you think needs to happen to open up that avenue even further?
So we've certainly seen an increase in demand for high-quality Australian education. As a top 50 university, like other top 50 universities around the world, we do enjoy strong demand from students who are looking for that really high-quality educational experience. We want to make sure that continues to be a trusted focus for where they want to come and enrol. And at Monash, we very much welcome the best students from right around the world to our shores. Chinese students do make up a significant proportion of our international enrolment, and that's partly because of where we sit in the region, but it's also about where we sit as a university along with other leading universities around the world. Families and students want the very best education to be able to go on in competitive job markets and likewise to be able to be really successful. And we want to be able to give young people that foundation in life. But what's really important to us at Monash is we want to be able to give our students a really transformative experience. So it's not just about getting a degree, it's about forming friendships and all of those other things that really matter. A really strong understanding of our region, really strong industry experience and so on.
Sharon, we've seen a lot of turmoil when it comes to higher education in the U.S., whether it's President Trump putting scrutiny on visas for international students, to even slashing science and university funding as well. Is this an opportunity for Australia, do you think, to try to attract more students from the U.S. or even from China to study in Australia?
Yeah. So I'm not sure whether you have children, but I've got children that are around university age, and not simply as a Vice-Chancellor, as a mother, all families want to be sure that when they send their children abroad, that they are welcome and that they are safe and that they can settle into their study and do really well. So what all families want, like my family, like your families, like many families around the world, they want to make sure that when they send their student abroad for a really transformative experience, they can do so in a really stable environment. So I think the more settled visa arrangements can be, more settled processes can be, more settled the overall settings can be, then you will find that the demand grows and grows.
Right. So have you seen students at least pick up an interest as far as your side of the world is concerned, Sharon?
So it's probably a little bit early to be certain around that, because we run a slightly different academic year to the Northern Hemisphere. So when many of your students in the Northern Hemisphere start in September, in Australia, most, not all, but most students do start earlier in the year, around February, March time. So we probably won't be able to answer that question with great certainty for probably about another 6 months or so, until we actually see how much of a shift there has been as a result of other changes in other parts of the world.
Sharon, thank you. Sharon, it's great to have you. Sharon Pickering there, Vice Chancellor and President at Monash University. Subscribers can watch us live and see our past interviews on our interactive TV function, TV Go. You can also dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation by sending us instant messages. Check it out at TV Go. Plenty more ahead. This is Bloomberg. All right, to a big scoop now from Bloomberg. We've learned that New World is looking to sell its flagship 11 Skies Airport Mall in Hong Kong to ease liquidity pressures, and sources say the company has initiated early-stage talks with the Hong Kong Airport Authority on its plans. Let's bring in our Bloomberg Conglomerate's consumer and gaming reporter, Shirley Zhao. Also want to bring in Trista Luo, our China credit reporter, talking a little bit more about this talk about whole bad bank story, which we'll get to a little bit later on. But Shirley, first and foremost, tell us a little bit more about what we know so far about this potential sale that they're looking at.
Right. So what we learned from sources is that New World is in early considerations to sell the 11 Skies mega mall project near Hong Kong's international airport. We learned that the valuation for the project is about 15 billion Hong Kong dollars to 17 billion Hong Kong dollars. Considering New World built the project for about 20 billion Hong Kong dollars, a sale would likely be at a loss. We also learned that New World has had some early discussions with Hong Kong's airport authority. Our understanding is that they need to be in close communications with the authority because the mall is on a site leased from the authority, and it's part of the Hong Kong government's broader plan to turn the airport area into a commercial center.
What would be the significance if a transaction does go through, and have any potential names emerged here as potential buyers for 15 billion, as you point out?
So we haven't heard about any potential buyers, but any sale, even if at a loss, would help New World ease its liquidity issue right now. So New World has much higher debt level than other major Hong Kong developers, and it's seeking urgent refinancing at the moment. It just completed a record $11 billion refinancing, and it's now seeking a new loan of about $2 billion. And it's also seeking to divest from its mainland properties. So we can feel a sense of urgency here.
Shirley, thank you so much. Shirley Zhao, there are Bloomberg conglomerates and consumer gaming report. And the broader theme here is, right, non-performing loans, debt burdens. Is there a corporate level fix, or do we need to entertain a sort of more systemic fix here as it pertains to that? So you have non-performing loans at Hong Kong lenders. Let me just give you some statistics. You have swelled to a point that some in the industry have floated the idea of maybe a bad bank being a good idea. Sources have told us that the concept could actually face some hurdles here. Let's bring in Trista Law, of course, who is here with us on set to talk us through this. So tell us more about what kind of conversations are taking place around this concept.
So we heard from sources that lenders, including Hang Seng Bank and Bank of Communication, had engaged with advisory firms and held early discussion to talk about whether they can set up a special vehicle to buy bad loan. So that's actually leads by these banks. And I think right now banks are thinking whether there's a creative way to help them to offload some non-performing loan off their balance sheet.
A lot of speculation right now. How realistic is it? Can it really come true?
Well, banks are thinking about more creative way to solve this problem. But right now, the discussion is still driven by banks. So we really need to wait and see how other banks and Hong Kong regulator will react to this. But as David mentioned earlier, that the number is not good. And maybe the reality is worse than what we're seeing right now, because some properties valuation has not really reflected on banks' books because there are few transactions nowadays. So I think there's an urgent there, but we really need to wait and see how regulator react to this.
Okay, Trista, thank you so much. Trista Xin-Yi Law there, our China credit reporter.
Yeah, let's get to the latest when it comes to U.S. bank earnings as well. Goldman Sachs has posted the best stock trading quarter in Wall Street history, with second quarter equities revenue hitting $4.3 billion. Now, that's about $600 million above analyst forecasts. Strong gains in intermediation and financing also drove profit past expectations. J.P. Morgan racked up $30 billion profit in the first half, more than double its closest rival, and widening its lead over Goldman Sachs and Morgan Stanley in investment banking revenue. Its market value now exceeds that of Bank of America, Citi, and Wells Fargo combined. But CEO Jamie Dimon says all its competitors are growing and expanding, and fintech companies are plotting to take big chunks of J.P. Morgan's business.
Now, let's stay with U.S. banks, and sort of the big story overnight was around the Fed and Jay Powell. Now, Brian Moynihan, of course, out of Bank of America, is stressing that the importance of an independent Fed as the long-running rift here between, President Trump and, of course, Jay Powell continue to intensify. Now, speaking to Bloomberg, he also discussed his company's second quarter earnings beat. Have a look.
This quarter was the trickiest quarter to get through because year over year, we finally got some NII growth, but year over year, the markets business doing strong, so expense growth was a little more robust. That'll get in line, and then you'll see NII drop to the bottom line, and it will set up for 2026 with even more growth.
When you talk about 2026, one of the things we're going to have is, in all likelihood, a new Fed chair. There's been a lot of talk, even today in Washington, about the Fed chair. And you've said you believe in an independent Fed. But if, in fact, President Trump gets his wish, as is his right under law, to appoint a new chair who will be more in line with his views. He said he thinks the interest rate really should be at 1% or even below that. Is that good for Bank of America? Is that good for the economy?
Well, let me make two things. One is you're absolutely right. In May of next year, the term of the current Fed chair ends after being reappointed, and it's the right of the elected president to appoint the next successor and go through Congress. And I think in that dialogue around that, there'll be a lot of dialogue about, okay, how do you set interest rates? What do you think about interest rates? Because the Fed is an independent agency, and they're meant to be outside the purview of the executive and the Congress. They are called to task, and they're monitored, and they're reviewed, and all the things. But the reality was it's set up to be independent, so that our central bank in America was independent. So I think no matter who gets in, they're going to look at it and have to look at the facts and make a decision. Because if you drop rates too far, inflation may kick up, and then you're going to have to raise them back quickly. On the other hand, if you think the prior Fed has been slow to lower rates, you might lower them faster. Our team believes that the Fed will lower rates in the second half of next year by 100 basis points. No change until then because inflation is still going through the system. That brings the Fed funds rate down closer to 3, which they think is probably more of a long-term rate, and frankly is more similar to what we had for most of American history. What's been unusual is the period after global financial crisis, a very low interest rate structure. That is really not a good place to be, honestly. We'd rather have a higher interest rate structure, a little more inflation, a little more robust economic growth. So I think everybody has to be a little careful about keeping that engine going.
And that was the Bank of America CEO Brian Moynihan speaking with Bloomberg's David Weston there. We got plenty more ahead. This is Bloomberg. Well, it is the summer, so it is graduation season in China. And for all you tiger moms out there and really sizing up the starting salaries of elite university graduates,
yeah.
this story and this column might be for you. After years and often a fortune, you've been pouring a lot of money into academic success, right? Does it all kind of work out? Let's bring in Shuli Red, a Bloomberg Opinion columnist. She's been kind of crunching the numbers and really asking just how much Chinese university leavers should be making and joining and really be, as they join the workforce and the like. What did you find, right? How much, for example, should a Tsinghua University graduate be making right now?
To be honest, I was very surprised how little they are making. A Tsinghua graduate with 3 years of work experience can, on average, expect to make just shy of $35,000 US a year, and that doesn't seem like very much because most Tsinghua grads that come into the job market, they have at least a master's degree. 80% of Tsinghua graduates with a bachelor's degree, they continue on to achieve more advanced studies, and then also Tsinghua has a lot of the so-called hot majors, basically information technology and finance. So we should expect at least perhaps 40 to 50% of Tsinghua grads being in technology or finance industry. And to me, $35,000 US a year doesn't seem very much because you can get that 10 years ago.
Is this a reflection of, well, the current state of the job market, or is it more a reflection of structural changes taking place, I guess?
I think it's both. So when I was talking to some people about how little Tsinghua graduates are getting paid, I got a lot of pushback. Employers basically say that they don't look at Tsinghua per se that way. Like big companies like Huawei and Alibaba, they will regularly recruit at universities, so-called 985 universities, basically the 39 best universities in China. And once you pass that 985 hurdle, everyone is on the same starting line, and the company they want you to prove yourselves before paying you more money. And also what we are seeing this year is that from all these Chinese technological breakthroughs, you don't have to have a Tsinghua degree to be innovative, right? The chief executive of Monash, he didn't go to Tsinghua. He went to Huazhong Science and Technology in Wuhan. And then the founder of Unitary Robotics that makes those dancing robots, right? He went to a really, you could say, community college in Shanghai. So the society, that talent pool is widening, and then the society is becoming more diverse. And the Tsinghua gets you into the talent pool after graduation, but it doesn't necessarily command so much of a price premium as 10 years ago.
That's so interesting.
Yeah, well, when parents look at how much they pay for their children's education, sometimes you measure it by how much it is as an investment. And I wonder whether we need to be looking at it through the same lens these days. And I think to your point you're making, right? People are comparing themselves to Manus AI, for example. But you're comparing yourself to not really your average student, are you?
That's right. And then there has been a lot of discussions with fellow tiger moms, basically saying, do I get good value for money from all the tiger parenting? And the one school of thought is like, why am I spending millions trying to get my kid to Tsinghua or Beijing University? Maybe they are not the material. I am better off, say, buying an apartment for them in Shanghai or Beijing. And when they grow up, they can decide what to do with that money. I mean, like, if you just become like social media influencers, they can get paid 15,000, 16,000 yuan a month, just showing that they're doing nothing, handing out every day. You know, like they're start to have a bit of a price calculation in China. We have been talking a lot about price wars, the notion of evolution. Yes. The evolution and the price wars in China. And people are also asking, what's the value for money, right? Like, what's the value of all that education? What does it get me?
It gives you food for thought, right?
Yeah. And
it's not all about getting that flashy degree. Maybe.
Yeah. Teach them how to, what did Elon Musk do to his kids? Teaching them how to solve problems instead of teaching them, right? Like, wasn't that, some of the...
In the world of AI, anything goes, right, too, as well.
It's not doing anything. Look at us.
Julie, thank you.
We just talk.
Our Bloomberg Opinion columnist, Julie.
Everyone writes everything for us.
And I'm not much of a tiger mom either. I thought I would be, but I'm not. TSMC, though, that's the one to watch.
Speaking of high expectations.
Let's take a look. The options traders are just going nuts on this, right? Yeah. On what really could come out today.
Because it's indicative of, obviously, so the last 2 quarters that TSMC came out with earnings, the focus on CapEx, and I think CapEx on average was up 95% on average in the last 2 quarters. And that is indicative, of course, of the AI play. And to what extent can the guidance be good enough to then propel the AI sort of rally, given the latest leg that we've seen out of Nvidia, right? So something good from TSMC could extend that rally even further, despite valuations being stretched. In this case, I think TSMC is at or near record highs, and its valuation on the Taiwan listing is nearly $1 trillion already at this point in time.
Yeah, I mean, 44% from the lows back in Liberation Day, right? So we are certainly seeing a tremendous sort of rally here. There are still some concerns, analysts say, whether it's the tariff or margin uncertainties, but overall, expect maybe things to look a bit better in the second half there. So I think people are expecting maybe that full year guidance. That's one thing to watch, whether they actually raise it, and if they actually even hint at even hikes when it comes to product prices, too. Okay, that's coming out in a couple of hours. The other stock that we're tracking at this point is out of Korea, and so talking all things K-pop, entertainment, and the stock is up. There's a story that I think there's something that is beyond that, something that meets the eye here, and of course certainly the founder is said to be now facing a probe over IPO disclosures. You can read about the story, of course, on your Bloomberg terminal. There doesn't seem to be any adverse market reaction, though, at this point in time. Staying in Korea, there's another stock that we're tracking here as well, SK Hynix. Yeah, we're watching some of these chip stocks in particular in Korea. Goldman basically saying that, look, the Nvidia supplier, you got to look at how competition is basically rising in that space. But yeah, a dramatic move there. We're down some 7% right now in Seoul. And biotech, we're getting a little more news there in China.
Yes, we are looking at that, and as you can see, substantial gains on your screens. And some of these names, by the way, and guests we had, of course, earlier on. Yeah, this was one of her top picks.
Akeso.
11% to the upside. You have some progress being made as far as corporate level is concerned. But yeah, anyway, we'll leave you with a look at aircraft stocks, and we'll tell you why maybe tomorrow, because that's it from us here on the China Show. Plenty more ahead, though. This is Bloomberg.